Welcome guys in this wonderful video. So I'm just going to be sharing with you just some small tips or things that you need to consider when you are trading a small account in synthetic indices. So this is going to help you, but it is not only going to help you in synthetic indices but in all the traded assets. So it is going to assist you. This is something that has helped me when I started trading this asset because I understood that at that time even the lot size was not decreased, it was still a bit high. So there were a lot of losing potential. So these are things that saved me that I'm about to share with you. So it's just few tips. I will share 3 with you, but in the process of sharing 3, there will be a lot of helpful things that are going to be added. So it's not just going to be 3 fixed, but it's gonna be a lot because a lot of things will flow as I'm speaking. So remember to like and share before you watch this video. So let us get into it. So okay, the most common thing, and this is something that we know, guys, this is something that we know, but I think it is going to sink when it comes from someone else because it's there in your mind, but a lot seem not to be practicing it. The problem about volatility indices, the problem about people who trade volatility indices, it is because of the infinite returns. It is because of the infinite returns, the happiness or the joy of making a lot of money in a short space of time. That's actually the main thing about trading VIX. It is that derive.com gave us the opportunity to make a lot of money in a very, very short period of time, meaning it gave us a volatile market that we can trade even on weekends. So you see that it's just like a dream coming true to a lot of traders, and yet from that perspective, that's where we take everything wrong. That's where we consider a lot of things as good, yet they are not good. So firstly, what you need to consider is that when the market gives you a potential of making a lot of money quick, it is actually tempting you to really fall into that trap. That's why you find yourself using a bigger lot size, because now you want to kill the market with a two-edged sword. The market is very volatile, and you also adding a big lot size. So it's 2 things now. The market is already active. The market gives you high return in a very, very short move. But you, on top of that, you add a bigger lot size. So usually when you have a small account, you'll find yourself saying, okay, I am buying here. And when you buy here, not that you didn't spot the direction. You spotted the direction, it's an uptrend. You buy here. But because you used a big lot size, you find yourself being taken out when the market comes here. You find yourself being taken out, not just taken out of this trade, but taken out of trading at all, because your account is going to be wiped. Why? Because you had a $10 account, you had a $20 account, you had a $50 account, but with a very big lot size that you opened. So you find yourself being wiped, and all of a sudden the market continues on your on the direction that you predicted. So these are things that are happening usual. Someone will buy even here, but because he uses a big lot size, when the market just goes down a bit, it wipes him out, and all of a sudden it continues, not because it didn't see the direction. I always say that usually the problem is not the strategy. The strategy is the last and least problem that traders are encountering. The problem, it is their mindset. They want to make quick returns in a very, very short period of time. Yes, in volatility we have been given that opportunity, and it doesn't mean that if you use a small lot size you will not make quick return. You will make quick return even in a small lot size, but it's just something that you need to keep in your mind. So that's the first issue that we have as traders. Make sure that you don't fall in this trap of lot size. Just use the minimum lot size. Use the smallest lot size as far as your account is very, very small. Use the smallest lot size. One can ask how small is a small account, or how big is a good account in terms of the amount. That what I once thought about the tradability of the account. Is that account tradable in such a way that can you divide your positions? Can you risk 1% of that account? For an example, it's hard when you're trading with $10 to say, okay, I will divide this $10 and risk 1% and so on and so on and so on. Because you'll find that when you put a stop loss, your stop loss hits -3, your stop loss hits -4. So it depends on the asset that you are trading, more especially in V75. You'll find that it hits your stop loss hits like -3 and whatsoever, or -4 if you're using the minimum lot size with a reasonable positioned stop loss. So it reaches to the question of saying, is your account tradable? For an example, I once say that if an account is $50 or more, it's easy for you to scale and divide that account into a fixed percentage that you can be able to risk. For an example, you can be able to risk $3, you can be able to risk $4, and you can have a lot of opportunities in $50. So it's on the tradability. But if you're trading, like for example V100, it is easy to say I will risk 1% because it is moving not quite aggressive as V75. It doesn't take as much as V75 does. So it depends on the asset if your account is tradable in that particular asset. So let's go to the second point, guys. This is very, very important. This is very, very important. The other issue, it is over-analyzing. Usually when you have a small account, you have that fear in you that I am not going to stay in the market for long. Then you find yourself over-analyzing, considering a lot of things, opening 7 time frames, putting 8 indicators, checking signals, asking your mentor if I should buy or sell. So it's just your mind clustered with over-analyzing the market. So which also makes you to lose more, because when your account is very, very small, it is very, very key to keep things very, very simple. It is very, very key to keep things very, very simple. Make sure that you keep things simple as possible. That's why I once told you guys about a simple strategy of trading support becoming resistance. Can I draw here? A simple strategy of saying I'm going to trade support becoming resistance. That's a strategy which I preached a lot in terms of volatility indices. That's the most basic strategy, which doesn't require any analysis. For an example of observing your resistance and waiting for price to retest it, or price to touch it, and when it touches it, you enter the trade. Same thing applies. You wait for price to come back in your resistance. When it touches it, you enter your trade. So it's just a basic strategy. But I'm not here for the strategy. I'm here for this message of saying stop over analyzing the market. Keep things as simple as possible when you have a small account, because simplicity, that's where you're going to make money. In simplicity, always keep things simple. Don't over analyze it. It makes you to panic. It makes you to even sell when you see that price is just going up. But because you've overanalyzed, you've checked a lot of things, it makes you to say, I'm selling here. It makes you just to panic. So stop overanalyzing the market. Just keep your analysis as simple as possible. And then this is also another major thing. The third thing, the last one, it is, guys, you have seen the position, you have seen the direction very, very well. You have entered the trade very, very well. So you have seen the direction correctly. You have entered the trade very, very well. And also you've analyzed very, very well. Your trade is running. It is profitable. And then here comes the other devil of the market. Guys closing trades early. That's the most toxic thing. It's the most destructive thing in trading. Closing trades early, closing working trades early. Never ever do that. The best thing it is just to scale your stop loss. Scale your stop loss. Just scale your stop loss. That's the best thing you can do. Scale your stop loss, guys. It is going to help you. It doesn't work that you have analyzed here, you've entered a buy here, and all of a sudden here, because you see the red candle, you close your buy with only, let's say, a profit of $10, and yet the market is still going to go up. What about all these returns? Remember, the key thing that makes us successful in trading, it is collecting two things: big wins and small losses. So if you cancel this thing, forget, the equation won't work. It won't work. You can be the best analyst, you can have the right entry method, but because you have taken out this issue of taking big wins, you won't make it. You won't make it. I'm telling you, it won't work. Because this is an issue of probability. So in probability, you have to make sure that when we make returns, we make a lot of returns. So this is something that is going to save you. I hope this video was helpful. Thank you for watching. Remember to like, share, and subscribe.